Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insights into the topics and issues that we've been discussing here at Quilter Cheviot. I'm Elliott Dixon, investment manager based out of our Edinburgh office. I'm pleased to be joined by our head of fixed interest, Richard Carter, who's back in the hot seat following a well-earned holiday. And with oil and gas markets once again in focus for investors, we're also joined for the second week running by Maurizio Carulli, global energy and materials analyst here at Quilter Cheviot. Last week saw a continued re-escalation in the Middle East, with the US and Iran resuming strikes across the region. Oil prices rose sharply on the week, up 16%, whilst Donald Trump vowed to reinstate a naval blockade of Iranian ports. Richard, turning to you first, clearly this is somewhat of a setback for markets, which had largely moved on from the recent conflict. What is your take on the resumption of hostilities? Do you feel that it's a minor blip, or is it sort of indicative of the fact markets should be a little bit more worried about a prolonged period of disruption?
Yeah, Elliot, I don't think it's a massive surprise, to be honest. In fact, I think if we go back a few weeks when the memorandum of understanding was signed, I think we said that this might not last very long because the agreement was always pretty vague and it kind of left a lot of the difficult stuff to later. And we all know the kind of history of the Middle East, and these peace deals don't tend to last for very long. So the fact that the fighting has resumed, I don't think is any great shock. But it's disappointing because there's really kind of no obvious end in sight. It might be that they sort of attack each other for a while and then agree that look, we do have to try and sign some sort of proper peace deal. But it's quite easy to see this just going on for months and months until maybe the US really decides to go in and even put ground troops in potentially. So I think it's disappointing, but I think the markets will just have to learn to live with it, I think.
And Maurizio, we saw benchmark Brent crude prices up sharply on the week. Do you feel that the market's correctly pricing in sort of a prolonged impact on oil production? Or are we in a position now where oil producing nations have adapted sufficiently that sort of these events are having a waning effect on the oil price?
A very good question, Elliot. Now, it is certainly true that the world is progressively adapting to live with disruption in energy markets after two wars in recent years, the Ukrainian war and the Iran war. And it is also true that since the first big oil shock in year 1973, the oil intensity of the world economy has nearly halved, i.e. the world consumes nowadays half of the energy per unit of GDP that it was doing 50 years ago. That said, one has to remember that the only reason for oil price today not being much higher is because the world entered the Iran war with a large amount of strategic oil reserves and commercial inventories of both oil and oil products. Now, over the past few months, a significant portion of reserves and inventories has been released, helping significantly to offset the Middle East supply disruption. And furthermore, at the same time, China, who buys more than 10% of the oil war production, has halved its purchases in recent months, benefiting from the use of a large amount of oil inventories that they had accumulated intelligently, I must say, over the past couple of years, and therefore relieving further the pressure on oil markets. But oil reserves and commercial inventories of oil and oil products are now much more depleted. And if the closure of the Strait of Hormuz will last for the rest of the summer, we may well see oil prices increasing further.
That's great. Thank you, Maurizio. And no doubt we'll be continuing to lean on your sort of thoughts and expertise over the coming weeks and months in the Middle East conflict. Turning our attentions now to economic data, closely watched US inflation figures were released last week, with June's Consumer Price Index, or CPI, figure coming in at 3.5%. This was down from 4.2% in May and comfortably below economists' expectations of 3.8%. Maurizio, coming back to you again first. Clearly, the fall that we saw was largely thanks to softer energy prices. Given that what we've just been discussing, do you think this could be short-lived?
Another cool question. Certainly, if the level of oil price will continue to be elevated, this will have an impact on inflation indexes. And this is why some economists believe that inflation is on the rise. Just to give you as a sort of gross rule of thumb, a change in oil price of $10 per barrel sustained over time, I stress that, determines about 30 to 40 basis points increase in consumer inflation indexes for developed countries. So it can be significant. But it much depends on the length of time that this level of oil price is going to be elevated. The recent escalation of military activity in the Middle East in recent days may cause a bit of concern. And also remember that central banks look certainly at the current level of inflation, but also at what the inflation could become over time in their decisions for setting interest rates. And this is why there are a number of central bank watchers out there who believe that the trend for central banks will be more of increasing interest rates rather than decreasing them, at least for in the next few months.
And Richard, turning to you, this seems to have been taken relatively positively by markets, and we saw a modest rally in US Treasury yields last week. Could you just walk us through why the inflation figures are being watched so closely at the moment, and sort of following on from what Maurizio just touched on there, what do you think this means for sort of interest rate expectations in the US?
Well, I think, to be honest, it's temporary relief because, there are a few sort of one-off distortions, I think, like things like motor insurance, but also, as you say, mainly a drop in energy prices and events have kind of overtaken that. So I don't think we should celebrate it too much, and also not forget the fact that the inflation rate of 3.5% is hardly low. I think the big story really at the moment is you've got the new Fed chair, Kevin Warsh. He hasn't really said much, and he keeps his cards close to his chest, but he does said repeatedly that they won't tolerate high inflation. So markets, I think, unduly even more sensitive than normal to the inflation numbers. I don't think the last numbers we should read too much into those as reasons I've said, but at the moment, interest rates look like they're more likely to go up than down, particularly if the whole conflict carries on.
Brilliant. Thanks, Richard. Moving on to events closer to home. Today sees Andy Burnham become the UK's 5th Prime Minister in 4 years, following an uncontested Labour leadership election. He inherits the unenviable task of turning around a UK economy with sluggish growth, May GDP coming in at 0.1%, and an increasingly polarised and dissatisfied electorate. Richard, to ask you first, what do you think the biggest challenges Andy Burnham faces in his first few weeks and months in office, and what, if anything, can he do to settle the growing political discontent?
It's a tough one for him. I think he's got to try, certainly from his point of view, try and boost Labour's position in the opinion polls and look like he's got a chance of winning the next election, which after all is less than 3 years away. And he's got to find a way of seeing off the popularity of reform under Nigel Farage, which may, Farage's troubles may help Burnham in some ways, but ultimately he's got to do what Starmer failed to do from a Labour point of view, which is to put policies in place that boost their popularity, but also sell them well. I think the problem is, Starmer maybe, there won't be a huge change what Burnham does from what Starmer did potentially, but if the presentation of it might improve, and I think that's what Burnham is, seen to be better at. His challenge really is that he's got to keep two sets of sort of conflicting people happy. One is the bond markets, because they can't really afford to borrow too much more. But on the other hand, Labour MPs have just put him into power, and most of them do not want to see spending cuts, and they'd probably be more happy to put taxes up and maybe borrow some more. So he's got a tough job. It's no more a tough job from the last sort of half dozen prime ministers we've had over the last few years, but he's got 2.5, 3 years really to try and boost his popularity, boost Labour's popularity.
And Maurizio, a key topic of debate politically at the moment has been energy independence. Labour previously had pledged not to issue any new exploration licenses in the North Sea, but over the weekend there was speculation that this may well be one of Burnham's first political U-turns of previous policy under the previous administration. Do you think this is something that Andy Burnham ought to be reconsidering, and what could it mean for UK oil and gas production if he does?
Yes, I mean, first of all, we need to see what Burnham will announce today and probably over the next few days on the subject. But to put the subject, the topic onto a framework, the energy crisis of both Ukraine and now Iran have made clear to governments that there is an important strategic goal the governments need to have, which is energy security first, and ideally energy independence second. And for energy security, I mean having the regular provisioning of oil and gas and any other energy source used in the country. And for energy independence, I mean the availability of energy sources inside your own country without depending of imports. And given the fact that the United Kingdom sits in the very close to a very important geological basins for hydrocarbons, which is the North Sea, which, yes, has been explored a lot and has been used a lot, but still has capability of producing more, and there is still the possibility, if the government wants, to find new oil and gas reserves. So it would be certainly, from an energy independence point of view, an important component of any government policy to restart exploration and increase production of oil and gas in the country in order to increase the energy independence of the country. And on the second, also there is a second element in any government policy in order to achieve energy independence is to increase the amount of renewables as energy sources, because renewables are by definition domestic, both solar and wind, and therefore they can, within the constraints of the energy intermittence that characterize them, can certainly help significantly energy independence. So the government should take a two-pronged approach. One, increasing further the exposure to renewables, but at the same time restarting the exploration and increasing the production of hydrocarbons in the North Sea that still remain an important hydrocarbon basin.
Thanks, Maurizio. And no doubt this is a sort of politically fraught topic that is going to keep in the headlines for the foreseeable until we get some clear policy from Andy Burnham and his new government. Richard, much of the focus within financial markets and what we do day to day has been around who Andy Burnham may appoint as his Chancellor, with Shabana Mahmood, the current front number for number 11. Could you just talk listeners through why there's such a focus on this appointment for Chancellor, and is Mahmood seen as a friendly appointment for markets?
Yeah, I think she's a bit of an unknown quantity, to be honest. Maybe that's not the best thing in the world, but it's better potentially than what markets feared, which was Ed Miliband taking over. And I think that generally you're looking for someone who actually, to be honest, like Rachel Reeves, it was a sort of safe pair of hands and was kind of good at sort of reassuring gilt investors that the government would play by the rules. They wouldn't do a sort of Liz Truss repeat and just sort of say, forget, we're just going to borrow as much as we need to get what we want to do, do what we want to do. And so it is an important appointment, although I would stress, I think with, you've got to be a little bit careful about over-interpreting what the Chancellor may have done or said in the past or whatever, because if Andy Burnham decides he wants to borrow more money to pay for various projects and defence spending, all the rest of it, the Chancellor's probably going to have to toe the line. But certainly, Shabana Mahmood would probably be a reasonable start. And clearly, the gilt market is extremely sensitive to any whiff of increased borrowing.
And do you get a sense that he will abide by those fiscal rules, or do you think they're there for tinkering or adjustment?
Well, I don't think he's got any choice other than to, let's say, take markets' views into account before doing anything. I mean, the fiscal rules have changed many times in the last, decade or so, and there's always a bit of wiggle room for how you interpret them. But I think it's the problem with Liz Truss, sort of the mistake they made was just to sort of go, not pay any attention to what the OBR had said, sort of, or sack people at Treasury or whatever, and just go for it. You can't do that. You need to explain why you're doing something. If you're going to increase borrowing to, fund infrastructure spending or do things around energy security or something, that's fine. But you need to have a bit of a long-term plan about how you get borrowing down. Otherwise, you're just going to end up paying interest rate costs, and it ends up costing you more than it should have done.
And Richard, come back to you again. You touched very briefly on the fact that he needs to get off to a fast start in terms of his approval ratings with the electorate. But ironically, do you think that it's internal Labour Party politics that will sort of take up most of his focus?
It shouldn't do. I mean, they've got an enormous majority. He should just be able to come up with, sensible policies and see those backed by MPs. But dealing with, as we saw from Keir Starmer, dealing with, the Labour Party, making sure they're happy, can take up some time. Albeit, I would be amazed if Labour MPs now want to be too negative about Burnham, because there's no chance of having another Prime Minister between now and the next election. So really, they've got to do absolutely everything they can, I would think, to support him.
And I guess final question for you, Richard. It appears that Burnham has got grand plans for devolution, nationalisation, personal taxation, and so on. But you touched on it there. With such a short period of time to implement change, how much of his success or improvement in satisfaction rates will actually be down to luck rather than design or policy?
Certainly a bit of luck. I think most prime ministers get tested by certain crises, whether that's sort of something like COVID or a foreign policy crisis. It's not really hard to, at the moment, to think about what foreign policy issues could test Burnham, given what's going on in the Middle East and also in Ukraine and relationships with the EU and America too. So those will probably be a big test. I mean, Andy Burnham comes into the job very much seen as a kind of domestically focused politician, and obviously dealing with being mayor in Manchester. He hasn't said much about foreign affairs and what his views are, but that's what will test him, those crises and those events. And it's fine to have these plans for devolution, nationalisation, all that, and you can probably start to lay the groundwork around some of that. I mean, Thames Water is going to be an early test case of their views on public utilities, but you're not going to get that much done in 2.5 years. And so if he wants to put those into place for longer term, he needs to win the next election. So in the short term, he needs to boost popularity.
Thanks, Richard. And it will certainly be interesting to see how his cabinet appointments unfold today. And no doubt in the next sort of few weeks and months will be sort of key for his success or otherwise. But Richard, Maurizio, thank you very much for your insights across a wide range of topics today. Before we do draw to a close, if any listeners have any questions that they would like to ask one of our analysts for a future podcast, you can put your questions forward to our team of experts by submitting them via the weekly comments page on our website. We'd love to hear from you. To stay up to date with our thoughts on markets and current issues, please visit our website at www.quiltercheviot.com. Here you can also see more of what we're doing at Quilter Cheviot, as well as watch past webinars on demand and subscribe to our weekly comment newsletter. We'll be back again next week. And in the meantime, for those of you on social media, you'll be able to see up-to-date content on our Facebook, Instagram, and LinkedIn pages. Thanks once again to Richard and Maurizio for their time and insights today, and to all of you for listening.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.